Cornelia Meyer is the CEO of Meyer Resources and a macroeconomist. She joins us now from Bern in Switzerland. Good to see you again, Cornelia. It's a bit like watching three different weather forecasts on different channels, and all three weathermen are telling you something different. Why this gap between the forecasts of the International Energy Agency, OPEC, plus the US energy information? It's kind of confusing. Why can't they agree?
They're looking at the world a little bit differently. Let us not forget the IEA in 2021 came out with its net zero prediction or edict. And they also came out and said no more investment in oil and gas needed. And they came out a few months ago saying, oops, if we don't have 540 billion a year between 2030 and 2050 investment in oil infrastructure, upstream, midstream, downstream, we can't keep current production levels going. So the IEA is swiveling away from its net zero edict to a more realistic stance. OPEC is actually very good in terms of analyzing the numbers, and the EIA is actually it's about 200,000 barrels away from the OPEC forecast. OPEC says, next year it will be this year it's 1.3 million barrels a day growth. Next year it's a little bit above 1.3 million barrels a day. The EIA is about 200,000 lower.
So at least they're agreeing on one thing, that there is an oversupply. Where is that oversupply coming from, and why isn't demand keeping up?
They're not agreeing on the oversupply. The IEA says there is an oversupply. OPEC says next year the markets will be in balance. They used to say there's a deficit, but they came up and they say it's in balance. And it's interesting is how do you count the barrels? There's so many black holes that we see here. On the demand side, China has been buying quite a bit of oil to put in its strategic reserves, stopped in October, and oil is in backwardation. It's usually not a time when you buy for reserves. You have the sanctions on Russia, and what usually happens with the sanctions on Russia, everybody gets very worried that the oil will not find the market, and the oil will then, in the end, two months down the road, find the market. And you also have an extraordinary amount of barrels at sea, stored at sea. My question there is, how many of these barrels are double counted, right? You count the ship in leaving a port in Russia, and then it goes into a port in Iraq and leaves that port again. What is that now? Russian crude? Is it Iraqi crude? Very hard to see how much that really is. So there is a lot. I mean, with quoting Donald Rumsfeld, there are a lot of known unknowns there.
Before we talk about the impact on oil-producing nations, let's talk about what all of this means for me and you and anyone watching. Goldman Sachs says that it expects crude to average around $56 a barrel next year. Does that mean that prices at the gas pumps will go down too?
Not necessarily, and I sort of disagree a little bit with Goldman's, because we are in that sweet spot between 60 and 70 barrels, and I think we will sort of stay there. But where there's this thing called refining margin. What you load at the pump in your car has gone through a refinery. So you have the crude price, but then you have the product prices, and products are more regional also than crude. Crude is the global commodity.
Okay, OPEC countries need prices at what, around $80 a barrel in order to balance the budget, to fund projects. You look at the investment that Saudi Arabia has promised to make in the US this week. What does this mean for them if the price of oil stays at somewhere around $60 a barrel next year?
First of all, it amuses me when people, including the IMF, come up and say, oh, well, countries need that price in order to balance the budget, because there's quite a few things in the budget that we know. There are known unknowns and unknown unknowns, to go back to Rumsfeld, in the budget. So I'm always very careful. What we have seen in Saudi Arabia is that last year and this year, for the first time, the non-oil sector contributed more than 50%, more than than the oil to GDP. So the economies are also weaving their way away from oil and gas. And that $1 trillion investment, you're right, some of that I'm sure will come from the PIF companies, which is the Saudi Sovereign Wealth Fund, but some of that will also come from private companies. So it's hard, it's not one for one. Yes, there are huge demands, and especially in Saudi, in order to implement Vision 2030, there are huge demands on the purse strings of the budget, and the higher oil price obviously helps more. But the whole point about Vision 2030 is to diversify away from the single dependency on oil.
It's always good to talk to you, Cornelia. Many thanks indeed for being with us.
Thank you very much.